Hey, what's up, my friend? So, in today's video, I'll share with you some day trading secrets and techniques, right, to help you in your day trading endeavor. Some of the things that I will share with you, right, is stuff that I learned back in my prop trading days. So, hopefully, right, you will, get some value out of it, right, and it improves your own day trading results. So, specifically, right, here's what we'll cover. I will talk about the best hours to trade for day traders, how to predict market reversals ahead of time, how to improve your winning rate using multiple time frame analysis. Then I'll talk about how to trade the news, right, without getting caught on the wrong side of the move. And also, why not all markets are created equal, right? Here's what you also must know. So, all this and more, right, in today's video. But first, okay, if you're watching this video right now, hit the thumbs up button and subscribe to my YouTube channel. The link is below. Hit subscribe. This way, whenever I publish a new video, you'll never miss a thing again, right? So do it right now. Hit the thumbs up button and subscribe to my YouTube channel. The button is below. Click subscribe. So with that said, let's get started. So the first thing that I want to talk about is the best hours to trade, right, for forex traders. So you can see it over here. This graph, it's from Owendar. Okay, you can see that not every hour in the forex market is equal, right? Even though it's open 24 hours a day, not every hour is the same, because you can see that this is the Asian session, right? Tokyo and the Sydney session. This is the London session, and then this is the New York. I can't see this. This is the New York session. Okay, so this is the New York, London, right? The bar start to the end means it shows the start of the session to the end of the session, and this one shows the start of New York session to the end of New York session. And you can see that this orange graph over here, right, shows you the volatility of the forex markets. And one thing that stands out, right, is that the forex markets, it is most volatile during the London session, from the start of London all the way to the end of London session. You can see that this is where the forex market moves the most. And as a day trader, you only make a profit when the market is moving. So the best time to trade, right, for forex day traders is during the London session. Okay, this is important. And to take things a step further, during the London session, right, not every hour is the same, because you can see that the first 2 hours of London session, right, let me just point out to you, right, the first 2 hours, right, there is volatility. Then the market goes into a doldrum, right, maybe traders, they're away from the desk, a lunch break, blah, blah, blah. And then when New York session comes into play, right, you notice that these 3 or 4 hours is where the market tends to be most volatile, right, during the London and New York session overlap. So you want to, employ so-called different day trading strategies, right, during different time of the day. Or rather, you want to be aware, right, of this phenomenon, right, during different times of the day. And with that said, right, for the first 2 hours, right, and New York overlap session, okay, generally, okay, this is just a rough general guideline, is that you want to be trading breakouts and trend continuation trade, because this is where the market is the most volatile, and there's a good chance, right, you could get a follow through, right, where the market continues to move in your favor. And for the last hour, generally, you want to be trading reversals, because if you look back again, the last hour of London session, okay, you can see that it's this bar over here, right? After this one, right, the market pretty much goes into a doldrum, right, where, the London traders, they leave the desk. Volatility of the market, right, simply just, just tank all the way to Asian session and then to the next day. Okay, so if you are trading the last hour of the London session, right, you want to be aware of this, that, after the London session closed, the market isn't really going anywhere. So this is where you don't want to be trading breakouts, because you're probably going to get stuck. You don't want to be trading trend continuation trades, because the market isn't going to move very much more in your favor. So what you want to do, if you want to trade it, right, you can consider trading reversals, where the market is unlikely to move any further, and maybe take a reversal trade back towards the mean. Okay, so this is something to really be aware of and consider when you are trading the London session. Next thing, right? How do you predict market reversals? So here's the thing, right? When the market moves each day it contains so-called a certain amount of fuel for the day. Okay, so generally, it's like, you can imagine it's like a car. Okay, if there is, let's say, 40 liters of petrol in it, right? Once you move a certain number of distance, once the 40 liter of petrol is used up, the car isn't going to move very much further. Okay, so it's the same for trading the markets, right? Each market, generally, there is a certain amount of fuel for the day. Once they hit that certain range of the day, it's unlikely that they will move further. Of course, there are, those black swan event where the market can really stretch very far, right? But generally, right, most of the time, right, they have certain amount of range that it tends to move within the day. And how do you actually determine this range, right? Is you can use the average true range indicator. So when the price, right, it moves 1 to 1.5 ATR within the day, it's likely exhausted for the day and unlikely to make, further move. So let me just share this with you. So this is the chart, right, of euro dollar. So you can pull up your average true range indicator, right, ATR. Okay, just click on this. I generally go with a 5-period ATR, taking into consideration the range over the last 5 days, and you click OK. So over here it spits out the value of the range of euro dollar, the average range of euro dollar over the last 5 days. So you can see that the average range right now is about 50 pips. Right, let me just zoom in a little bit, right? About 50 pips, right? So what it's telling you is that over the last 5 days, right, euro against the USD has moved an average of about 50 pips a day. Okay, so this means, right, let's say if today the market open, right, it moves about 50 or 75 pips, right, you know that probably it has hit its so-called upper limit of the range and is unlikely to move further. So here's how you can, sort of like, plot your levels on the chart, right, where the market is so-called potentially exhausted. So what you want to do is, again, right, find out what's the daily ATR. So for this is 50 pips, right? You go down to the lower time frame. You can go to the 15 minutes, the 5 minute, or the 1 hour time frame. It's up to you, right? I use the 15 minutes time frame here. And then you want to find out what is the opening price of the day, right? So the market opening price we'll take is the New York close chart. So the price opens at 5 a.m. Singapore time, right? If you're in New York, right, it'll be 5 p.m. So one simple way, just go to daily time frame. And if the day candle is already moving, find out what's the opening price of this candle. So the opening price is 0972. Okay, so you just go to the 15 minutes time frame. It will be around the 5 a.m. mark, okay, which is this candle over here, 0972. Okay, so I'm just gonna plot this over here, find out where's the opening price. All right, just do this quickly, 0972. Okay, and you can see that this one is pretty much referencing the 5 a.m. candle. Actually, it's 725 to be exact, right? To be exact, okay? It's actually referencing this candle here, right? This open. So you have seen earlier on the daily time frame, right? The ATR is 50 pips. So what you're gonna do is to take the opening price, which is 0972 plus 50 pips, right? So just get a calculator, 0972 plus 50 pips, right? You have a value of 1022, right? So just change this to 1022. Okay, press OK. So now you can't see this, just pull this down a little bit, right? You can see that now this one is on top. Okay, and also you want to take the 0972 minus 50 pips, right? So 972 minus 50 pips, and you get the lower end of the range, 922. Okay, so what does this tell you? This level over here tells you that from the opening price of the day, when the market has moved up 50 pips, right, this is the level, right, that you're looking at. And if the market moved down 50 pips from the opening price at 0972, this will be the level that you're looking at. So in other words, right here, right, means the market has moved up 1 ATR for the day. And over here, it means that the market has dropped 1 ATR for the day. So this isn't an exact science, right? So this is why you want to use a range between 1 to 1.5 ATR. So over here, right, you can just add the range again. So you just take a 972, right, 1.0972, add on 1.5 ATR, which is about 75 pips, so just plus 75. You get a value of 1047. So just put this one out, 1047. Okay. And for the bottom one, okay, 972, you minus 75 pips, you get a number of about 897. Okay, so now I just zoom out this a little bit further. I can see that now we have our range on this chart. On this chart right now, you can see that where could the market potentially exhaust itself for the day. So I'm going to zoom out a little, right? So you can see that the range now, it's pretty broad, right? This is 1 ATR. This is 1.5 ATR. Okay, so this over here is 1 ATR below the open, and this is 1.5 ATR below the open. So you can see that we have range now where the market could potentially, exhaust itself for the day. And one more thing to add is that, you want to look at market structure, support, resistance, right, to really identify this type of high probability reversal areas. So what you're going to do is, again, very simple. Just look left, zoom out, look left, and see where any key structure the market is coming into. And you can see that over here for euro dollar, there's a key market structure somewhere about here, right, around the 1.5 ATR level mark. Okay, so somewhere about here. Okay, so this is, if you ask me, right, this is a high probability area, right, for today, where if euro dollar hits that area for today, right, there's a good chance it could reverse from there because it is 1.5. This level is 1.5 ATR from the open, and it coincides, right, with a previous support, right, that could now act as resistance. So this is, I would say, it's a high probability reversal area for today. All right, if you want to short, right, this is definitely an area you want to pay attention to. And if you want to long, right, then this would be an area to be looking at, right? You can see that this one is 1 ATR from the open, and it has a confluence of this area, this swing low over here. So this area will be a good area to be looking for buying opportunity, right, if you're bullish on euro dollar for today. And one more thing to add, right, you have seen earlier the slides, right, I mentioned that time of the day, right, if the market, right, it's at the last hour of London session, it's unlikely to move further. So you can see that now there are a number of factors coming in, right? Let's say, for example, euro dollar comes into this highs, okay? This is 1.5 ATR above the daily open. On top of it, it has the confluence of this market structure, previous support term resistance. And on top of it, right, this is now the last hour of London session. So you can see that when all these factors come together, right, this really, right, is a very, I would say, a high probability area, right, that you want to look for shorting opportunity, right, where there's a number of factors all coming together, right, to make this a high probability short trade. Okay, so I hope you can understand, right, how, you know, to plan your attack, right, areas that you want to trade from, right, as a day trader. There are different things that you can look at. Okay, so this is how you actually go about doing it, right, how to actually, you know, predict market reversals, right, using the ATR indicator as well as looking at confluence factors like support, resistance, and the time of the day. Moving on, right, how do you improve your winning rate? All right, so as a day trader, right, whether you're trading the 5 minutes time frame, the 15 minute, or the 30 minutes time frame, you want to be aware of where you are on the higher time frame, specifically the, let's say, the daily time frame. Okay, so let me just explain to you. Okay, so let's say on the daily time frame, right, the market is in a trend, right? It's making a trending move. This is a retracement move, a trending move, retracement move, a trending move. So what I mean by is, you know, you want to trade in the direction of the trending or retracement move on the daily time frame. So let's say on the daily time frame, right now the price is making something like this. So right now we are on the retracement leg on the daily time frame. So on the lower time frame, you want to be looking to short. You don't want to be looking to long. Yes, I do agree that on the daily time frame, the general trend is up. But you have to remember that you're a day trader. You're not a higher time frame trader. So if the higher time frame is making a retracement move, on the lower time frame, it is probably in a downtrend, and you want to be looking for shorting opportunities. Okay? If you want a long, fair enough, you can do that. What you want to do is, if you don't want to trade the retracement move on the daily time frame, wait for a breakout and trade in the direction of the trend. So let's say the market now has hit higher. The retracement move seems to be ending. At this point, right, you can look for buy opportunities on the lower time frame. So this is what I mean by, you know, you have to understand where you are, right, in the big picture. So let me give you an example. So let's say, okay, let me just look at this. Okay, let me just get rid of this indicator. Okay, if you look at Euro Aussie, okay, Euro Aussie, oh, this is the wrong one. Euro Aussie. Okay, click on this. You can see that Euro Aussie on a daily time frame, you'll notice that it's in an uptrend, right? In fact, I can just, you know, just quickly draw some levels over here, right? And we can all agree that generally Euro Aussie, it's in an uptrend, right? Series of higher lows, right? Over here, right? You have higher lows, okay, and higher highs. So it's in an uptrend. But remember, I said that you want to be trading, right, aligned, right, with either the trending or retracement move. And as of right now on the daily time frame, Euro Aussie, right, it's having its retracement move right now. Notice that the market, right, is heading lower. So if you go down to the 15 minutes time frame, you notice that the market is already in a downtrend, as I've mentioned earlier. So a mistake, right, that many traders make is that they get their buyers on a higher time frame, but they are trading against the trend. Does it make sense? So for example, they will look at the daily time frame and they say, oh, higher time frame is in an uptrend, right? So I should be buying. So they go down to the lower time frame, the 15 minutes time frame, and they look to buy. And they wonder why they keep getting stopped out. Well, the reason is simple, right? Yes, you're trading with the trend on the higher time frame, but you're trading against the trend on the lower time frame. Okay? So your priority right now is on the time frame you're trading, and the time frame that you're trading now is in a downtrend, and you should be looking for shorting opportunities. Okay, so in this case, you can see that, you know, that the big picture, the market is in an uptrend, the lower time frame is in a downtrend. So there are one thing to pay attention is that since you know, right, that you are trading against the higher time frame trend, right? What you want to do is that you can take shorting opportunities, but you want to be more active, right, in your trade management. You want to be quicker with your exits. You don't want to hold your trade too long because you know, right, you are trading against the trend on the higher time frame. So you want to be more quick with your take profits and stuff like that. Okay, so you can see that this is an example, right, between the daily and the 15 minutes time frame. Let me give you another one, right? In this case, let's say the pound Swiss franc. Okay, so over here you can see that at this point, right, pound Swiss franc, you can see that this market, right, it seems, right, to be heading lower. This retracement move seems to be coming to an end, right? Can't really tell. So what you'll do is that, okay, I know that on the daily time frame the trend is down. So you go down to the 15 minutes time frame, you just zoom out a little bit, right? And you notice that this market, okay, this is actually an area of previous support, right? Previous support now become resistance. So now, if you want to, let's say, short this market, right, you know that over here, this area is a good, favorable trade location you want to be trading from, because here now, you know that you're trading aligned with the higher time frame trend, which is towards the downside. So if you're looking for short setups over here, you are more inclined, right, to be willing to hold this trade longer, because now you're actually trading in the direction of the longer term trend. So can you see, how you can actually, get your buyers to know whether you should be buying or selling, right, based on what the higher time frame market structure is. Okay, and let me just take you back to the Euro Aussie one. So for the Euro Aussie one, let me ask you, when will you be looking to buy in this market condition? Let's say, for example, now the daily time frame, right, it's in an uptrend, but when do you actually look to buy on the lower time frame? So what you can do is use a technique, what I call the trend line break. So you go down to the 15 minutes time frame, connect a trend line, right, between two obvious points, right? So in this case, let's say between these highs, and I see these highs over here, connect this level. Okay, so at this point, let's say on the lower time frame, right, until the price can break above this trend line, make a series of higher highs and higher lows, only then, right, will I look for buying opportunities. And this time around, if I buy, I'll be willing to hold the trade longer because I'm now trading in the direction of the higher time frame trend. Does it make sense? Okay, so the key thing to know, right, when you are a day trader, you want to ask yourself, right, is the higher time frame now in a trending move or a retracement move? If it's in a trending move, you want to be trading in the direction of the trending move and possibly, holding your trade longer since you're trading with the trend. But if the higher time frame is in a retracement move, right, you want to be trading in the direction of the retracement. At the same time, you don't want to be too greedy with your take profit level because you know that you're actually trading against the higher time frame trend. So you want to be more quick, right, with taking profits. Does it make sense? Okay, I hope this helps, right? This is important, right? Using multiple time frames, right, to improve your winning rate and your entries. Okay, so this is how you do it, right? Moving on, right? How would you trade the news? Okay, so one thing about trading news, right, is that you have to understand the market behavior, because market behaves differently to different type of news that's coming out. For example, non-farm payroll, right, based on my observation, generally what happens is that NFP, before it comes out, right, the market, let's say, you would tend to, let's say, go into a doldrum. It goes quiet, right, before NFP. And when NFP is out, right, you will make a spike up, down, and then it goes back quiet once again. Sometimes it can spike down first and then go up, right, and vice versa. But generally, this is what I noticed on NFP, right? Before the news come up, right, market goes quiet. When the news is out, it creates a spike up and down, right, triggering stops up and down, and then it goes back to where it was, before the news release. Okay, so this is what I noticed on NFP, and I don't know what news you want to trade, right? You have to understand the market behavior, right, for that particular news release, whether you're trading stocks, forex, whatsoever. So for NFP, right, usually what you want to do is that if you want to ignore the first move that comes out, right? So for example, NFP news is released, right? Market spikes up higher. You don't want to buy. You want to ignore that first move. Okay? What you want to do is to camp, right? To wait at market structure. So when the first spike comes up, right, there's a good chance it could reverse back in the opposite direction. And that's where you want to be waiting, right? Camping, right? I used to play Counter-Strike. We call it camping, right? Waiting at market structure, right? And then to trade the reversal at market structure. Okay, so let me just explain to you what I mean. Right, I think charts usually is much easier to interpret. So NFP recently we have one is on a August 2nd, right, Friday, about 8:30. Okay, so I go to the, you can see over here, right? Okay, let me just delete the levels. So you can see over here, this candle here is the, is this the one? 10:30. Let me find this. Oh, this one here, sorry. 8:30, right? This is the candle, sorry. This is the candle, right, where NFP is released, right? So as mentioned earlier, you want to ignore the first move. So the first move, right, out of NFP, right, market hit down lower, and then it hit down lower. At this point, right, ignore the first move. Second thing is to wait at market structure. So you can see that price came into this market structure over here. Let me just draw it out. Okay, price came into this market structure over here, right? Previous resistance, resistance, now act as support. Okay, this is the first move, right? Ignore it. Price now came into market structure. Then you want to trade the reversal of it, right? You can see that over here, the next candle, you have somewhat of a higher close, a bullish close, showing you price rejection. The next candle, right, indecision, right? And when the price break above this highs, right, it rallies up higher in the opposite direction. Okay, so this is kind of the phenomenon that I usually see in NFP, right? Prior to the news release, right? Prior to the news release, market goes quiet. News is out, it spikes up, spikes down, goes back up, and then goes back quiet once again. And in this case, it's a variation of it, right? Market came down lower, and then it spiked up, and then right now it's pretty much in doldrum. Or I can see over here, right? Doldrum again, and then here it's a new day already. Okay, so this is the NFP phenomenon that I noticed. So if you want to trade news, right? Again, my point is, again, you have to understand the market behavior. And finally, right, I want to talk about is, why not all markets are the same, right? Yes, you can trade forex market, you can trade stock markets, but markets behave differently, and it's very easy to prove, right? So some markets, they have more of a trending characteristics. This means when the market, whenever it breaks out of a new highs, it tends to continue in that direction. And certain markets, they have a mean reverting characteristics. This means when the market breaks out of the highs, it doesn't continue higher, it tends to reverse. Okay, so a very simple test that you can do, right? This is a technique that I've learned from Andrea Unger, a World Cup trading champion, is this. It's a back test that you can run, right? What you want to do is to buy the breakout of previous day high, right? One lot, just buy one lot on the previous day high. You hold that one lot position, right? That long position until the price hit the previous day low. And then when that happens, right, you exit that long trade and you go short. Okay? And you hold that short trade, right, until the price breaks above the previous day high. And then you go long. So you rinse, repeat this process all over again. So now, if you do this so-called test, right, this back test, right, and you notice a particular market with an equity curve, right, that is sloping up higher over time, what does it tell you? Well, it tells you that that market, right, let's say this is on the daily time frame, that market, right, is a trending market on the daily time frame, because whenever the price breaks above the high, there's a good chance it will continue higher. That's why the equity curve, right, is sloping higher over time. On the other hand, right, if you see an equity curve, right, of a market that's heading down lower over time, what does it tell you? Well, it's telling you that that market is probably a mean reverting market. Whenever the price breaks out of the high, it doesn't have a tendency to go up higher. Instead, it tends to reverse, right? That's why you lose money, right, when you reverse, right? Because what we are doing is that we are buying when the price breaks above the previous day high and hold it until, it hits the previous day low, okay? So if it breaks out of the high and reverse, right, it means that we are losing, and that's why your equity curve is sloping down lower over time. And this tells you that the market is a mean reverting market. And an example I can share with you is this, right? If you look at this, right, Aussie Canadian, right, applying this particular back test, Aussie Canadian, you can see that this market, right, since I would say, I think 2008, okay, till 2018, right, this market has a downward sloping equity curve. This tells you that this is a mean reverting market, Aussie Canadian, right? The particular test that we did, right, on this Aussie Canadian is a mean reverting market. That's why this equity curve is sloping down lower over time. On the other hand, you have pound yen. It's the opposite, right? It's actually sloping up higher over time. This tells you that pound yen is a trending market. Okay, so this is just a very simple test that you can do, right, to find out the characteristic of the market. Is it a trending market or is it a mean reverting market? And why is this important, right? Well, if you know a market behavior, if you know it tends to trend, right, what you can do is you can hold your trades longer, right, when you're day trading, because it tends to trend further in your favor if you know it's a trending market. But if you know that the market tends to mean revert, right, then this means that you could possibly want to take profits, right, at the the day highs, previous day high or previous day low, because that's where it tends to reverse. And on top of it, right, you can also look for reversal trading opportunities, right, at the previous day high and low, right, for mean reverting markets. And this is only possible, right, if you understand the market, right, the behavior of the markets you're trading, whether is it trending or mean reverting. Okay, so this is a very simple test. You can do it, right, and find it out yourself. So let's do a quick recap, right, to what we have covered today, right? We have covered a lot, I know, right? So number one, focus on trading the most volatile period of the day, right? So for forex traders, it's usually the London session. For stock traders, it's usually the first hour and last hour of the day. Number two, right, if the market moves, right, 1 to 1.5 ATR of the day, chances are it's exhausted, and you can use confluence like, support, resistance, and time of the day, right, to help you, time your entries as well for day trading. Number three, understand the big picture on the higher time frame and then trade in the direction of it. Number four, if you want to trade news, right, understand the behavior to how price behaves, right, before, during, and after news release, right, and then you can take advantage of the behavior of the market. And number five, right, know the behavior of the markets you're trading, whether is it a trending market or whether it's a mean reverting market, right. From then on, you can use the appropriate trading strategies to trade the so-called behavior of the markets, right, that you find that you realize, right, that, like for example, if pound yen is a trending market, you want to apply more of a trending strategy or breakout strategy. And Aussie Canadian, it's a mean reverting market, you can look to trade reversals. Okay, so this is important, right, knowing the behavior of the markets that you're trading. And finally, one last thing, right, if you want to learn more about my trading strategy, my approach, go down to my website, tradingwithrayner.com over here, right, and download this guide, the ultimate guide to price action trading. We will talk more about support, resistance, candlestick patterns, entries, strategies, and much more. Okay, so just go down to my website, click this orange button, right, and I'll send it to your email for free. So with that said, right, I have come towards the end of this video, right. If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel, and I will talk to you soon.